let's get right into it. Let me share my screen first of all. Now we can start as soon as possible. Start broadcast. Okay. Can everyone see my screen?
Yes.
Yes.
Okay. Good. Now we are starting with let me exit this right here. Let me exit this. Let me go to the Bybit homepage. Now, this is the Bybit. When you open your app, this is what you see. Today we are going to start with, I'm going to be using a demo account to show us certain trades because we're going to be placing live trades. Now you can see the demo account is on, you can see demo trading on the top left of the screen. So I'm going to click that right now. And we are going to get right into it. So this is demo trading. This demo account has about $60,000. Now, when I'm coaching you guys one-on-one, I'm going to show you how this demo account works. Immediately you create your demo account, you're going to see $100,000 there or so. You're going to delete the funds and put in funds commensurate to where you are financially. Whether it's $1,000, whether it's $2,000, whether it's $500, whether it's $100, you're going to put in funds commensurate to where you are financially. Now, as you can see there, I have $60,000. Actually, this is the use of a demo account. You use it to test trading strategies. You use it to trade. You trade as real as though it is a real account. Now, some people say a demo account is not real money, so they are not going to be able to really feel the emotions of a real situation. But I'm of the opinion that where pilots train to fly planes through simulations, they cannot be thinking this is just a simulation, so I can do anything. They will never be able to fly an actual plane. So with this demo account, we'll be able to. I have personally grown this demo account in the last 2 months from $50,000 to $60,000. I mean, that's commensurate to where I am. I'm a fund manager for some high net worth individuals. So I always test out trades with this demo account. So now we're going to click trades. We're going to click trades. I hope everybody must have seen me clicking trades. These are some live trades I have ongoing right now on the demo account. As I said, I'm always using it to place trades. Now we're going to click trades. Now we're going to switch to futures. If you look at the top part of the screen, you can see that it's on spot. I'm going to tap that futures there right now. I'm going to tap futures. So now we have switched to futures. This is what is called futures trading. That's what we're about to learn right now. Now, the first thing that we are going to learn from trading futures is the difference between isolated and cross margin. Underneath the graph, I'm going to tap that button called isolated. I'm going to tap that button right now called isolated. And we can see isolated, cross, or portfolio. We are going to be working with isolated for the purposes of this class. Now, what does isolated and cross margin? What is the difference between these two? Now, in leverage trading, like I introduced yesterday, let's say, for example, you have $100. You are going to be using that $100 as though it's $300, as though it's $400, as though it's $1,000, as though it's $600. That $100 is called margin for the purpose of leverage trading. The money that we are going to use times whatever is called margin. So anytime I use the word margin, I'm referring to our capital to leverage trade. Now, isolated margin means that we want to use USDT, a digital version of the dollar, to place our trades. That means we are going to solely use USDT for our margin. That's the digital dollar. Cross margin means we can use USDT, we can use Ethereum, we can use Bitcoin, we can use Solana, we can use every kind of cryptocurrency as our margin. Let's not get confused with the term. I'm going to try my best to simplify it. Margin means the money we are using to place the trade in this scenario. So that's basically the difference between isolated and cross margin. So we always prefer to use isolated because we don't want a situation where we are using our money to make a trade. Then in cross margin, our money that we use to place the trade is depreciating. Why? Because it's a volatile cryptocurrency. So if we stick to US dollars, USDT, it doesn't fluctuate, it doesn't move. I hope we get that point. It doesn't move. So we use that as our capital. So that's why we are going to leave it at isolated. Now, the first thing I'm going to do, I'm going to place, I think I already have a live trade on Bitcoin. So I'm going to be starting with Bitcoin. Now, if we wanted to buy Bitcoin, I'm going to, for the purpose of this class, I'm going to add to my Bitcoin position here. But I already have a trade placed. Now, if you wanted to place a trade now from scratch, the first thing you're going to consider is the amount of times you want to use that money. Let's say, for example, if the margin is a, let me use a, that's, if the margin is, I want to use the margin as $1,000 for purpose of this class. That's too much, okay? So this is basically $1,000. You can see the cost part says $1,058. The value part says $3,167. What does that mean? That means that the capital we're about to use for this leverage trade is about $1,000, and it is going to work as though it is $3,167. So it's going to work 3 times the power of our capital. Now, what determines the amount of leverage we take on? Leverage simply means whether we are going to use that $1,000 as $10,000, $100,000, $3,000, $2,000. Now, for the purpose of safety, there are principles that we taught in the last class on risk management, but this is the application. When we are managing our risk, and I want to point this out before I place this trade, for you to use $1,000 to place a trade like this, in my opinion, you have to have about $10,000 minimum. So, like I said, when you are creating your demo account, you are going to put funds relative to where you are. Because if you had, let me say, $10,000 in this portfolio, I originally had about $50,000. I've grown it to $60,000. You are going to shift. Let me say you had $10,000. You are going to put about $9,000 in your MetaMask wallet and leave $1,000 here on Bybit, because that's risk management. Now you want to only trade with $1,000 and keep your $9,000 safe. Why? Trading has its risk, but we know how to manage risks. That's why we are here. Now, this $1,000 is going to work as though it's $3,000. If now that we have $1,000, before I place this trade, I need to explain the principle of dollar cost averaging again. I really need to explain that because that will really help us in our. I used the $1,000 example yesterday. So basically, if you were working with $1,000 for this trade, you'll be using $200 to make this trade. Now, let me just go ahead and place the trade. Now we can see this is 3x. This is where we are going to change the leverage. There is 3x. You can customize it. You can either choose to use 2x, 4x, 8x, 9x. If I use this, the money will be working as $9,000. But for the purpose of risk management and safety, we are going to be using 3x. Now, the higher leverage we use, you can see I already have a Bitcoin trade placed here in that place showing BTC long. The higher the leverage we use, the higher our liquidation, this estimated liquidation price comes up. What does an estimated liquidation price mean? If the market should drop to that price, you are going to lose all your money. That's basically the definition of liquidation price. Like I said yesterday, we are professional investors. We are never going to let that happen. But it's good to know that the meaning of liquidation price If the market goes to that place, you are going to lose all your money. And the liquidation price is determined by the amount of leverage you take on. For example, in this place, I'm using Bitcoin. The first trade you can see here is a Bitcoin trade, and the money is working as though it is 3 times. The liquidation price is 72,317. I'm going to take us now to my Binance account to show us another trade. We'll be coming here to learn 1 or 2 things later on. I'm going to go to, if we look at the screen now, we can see there is a trade currently on here on the Binance account. This is also a trade in Bitcoin. We can see BTC, USDT, PEP, isolated 2x. What does that mean? This money is working as though it is 2 times the capital. Now we can see the liquidation price here is $53,874. Why is the liquidation price less than the other one? Because this is just 2x, while the other one is 3x. So the higher the leverage you take on, the more the risk. So we expect to, as we grow, we expect to reduce our leverage, not increase it. Now, don't ever use anything for Bitcoin. Don't ever use a leverage above 4x. Now, there are certain points where the market is that we can use 4x. If you use 20x, 30x, 40x, the likelihood of you being liquidated is very high. You could place a trade now with 40x, and the price of Bitcoin now is 105,560, and your liquidation point is 105,100 with 40x or 50x or 60x. So your risk of liquidation is almost 100%. You don't want to use anything above 4x, but for the purpose of this class, I'm making it even much more safer by using 3x, because Bitcoin is currently above 100K. So we are managing the risk. Now, I've placed the trade here already, but if you were to place the trade, you just click long. Long means that you are basically saying that investing in the market going up. Short would have meant that you are investing in the market going down. We are going to come into the short strategy later on, but let's first of all start with the long. Now, if we look at it, I have placed here, it's called BTC USDT long. Now, we can see my position size. Position size is 0.03 Bitcoin. What does that mean? Basically, that means that 0.03 Bitcoin is working for me in the market. So I'm going to see the value of that in dollars when I click the contract right now. I'm going to click the contract right now so that we have a perfect understanding. Now, this is the contract. Remember, you are in leverage trading. You are buying a contract. It's called perpetual contracts. You are not buying the asset itself. You are not buying Bitcoin itself. You are buying a contract. If you want to buy Bitcoin itself, I refer you back to the class of spot trading yesterday. So now this is the contract that you are buying. Like I said, position size is 0.03 Bitcoin. If we look at IM, just maybe fourth to the last, IM means initial margin. Remember, margin means our capital here. The capital we are using for this trade is $1,077. That's the capital. If we look at value basically means our $1,077 is working as $3,230. Entry price means that we bought this contract at the price of $107,668. What does mark price mean? Mark price means that as far as the contract is concerned, this is the price of Bitcoin as at now. Now, the contract tries to keep up with the price of Bitcoin. Remember that the contract is not actual Bitcoin, but the contract tries to keep up with the price of Bitcoin. I will explain how the contract does that shortly. Estimated liquidation price. Like I said, once that estimated liquidation price is reached, you are going to lose all your money. But we can manage that, as I'll show us moving forward. So unrealized P&L is unrealized profit and loss. Basically, I bought the contract at $107,668, and now it's on a $61 loss. But I have not sold. I have not realized this loss. I've not realized this loss. That is why it's on a $60 loss. Actually, this should not concern you based on this is a trade. The market is going to be fluctuating back and forth. So that's not we're not really bothered about an unrealized loss. At some point, we are going to be in profit in this trade and we're going to sell and realize our profit. Realized P&L, realized profit and loss. Now, what this basically means is something called funding rate. What does funding rate mean? Now, this contract is not free. They charge you fees for purchasing this contract. Now, the fee is relative to the amount of money you use. For example, I used $1,000 to purchase this trade, and the fee they charged me is $2.8. Now, the way a funding rate works is that this is a contract. It is not it's not exactly Bitcoin. So for the contract price to keep up with the price of Bitcoin, they charge a funding rate. If, for example, Bitcoin is going up, they start charging people that are holding BTC long. That's people that are invested in the market to go up. They start charging them a specific funding rate so that it would incentivize people that are shorting the market to make money. I know that concept is kind of complicated. Actually, it's not really necessary to our trading, but I just want us to grab that concept that there is a fee that is charged for holding this contract. I guess that's simple enough. You can find that fee in your realized P&L, realized profit and loss. So now I'm going to go back to the contract.